Hi everyone. We're going to be looking at Chapter 16 in this video, Revenue and Customer Profitability Analysis. First of all, my apologies for taking so long to get this out to you guys. Just trying to figure out the technology to get this all recorded took a little while here, and I do apologize for that. What we're going to do is we're going to work through the lecture, first on revenue and customer profitability, and then I'll post a separate video looking at some practice questions dealing with revenue variances, bundled products, and so on. In this chapter, you're going to have to learn how to allocate revenue from a product bundle to the distinct components in that bundle. So for example, if McDonald's sells a combo, how do they figure out how much goes to the Big Mac and to the fries and to the pop? We're going to look at an ABC system to allocate costs, but looking at the customer themselves as the cost object. So basically looking at how much does it really cost to keep a customer. We're going to calculate and interpret the 4 levels of contribution margin or sales variance analysis. And again, when we're looking at those, I'll walk you through which ones are important and how they all kind of come together. This is very similar to the things you looked at in managerial accounting regarding the static and flexible budget variances. We're going to look at how to generate a customer profitability profile so we can see which customers are profitable and which ones are not. And then finally, we're going to look at relevant profitability data to decide whether to keep or drop a customer or a branch. Alright, so one important thing here is that allocation is not the same thing as tracing. When we talk about allocating revenue, what we're saying is we already have earned the total amount of revenue. We're just trying to figure out how much of it goes to each of the different products in a bundle, for example. It might not be economically feasible to actually trace specifically the revenue to a particular product, or it might just not be possible. Now, there's a few different methods you could use for this. One is called the standalone method, and one is called the incremental method. We are going to look at both. You are responsible for both. There are other subjective methods as well that businesses may use if one of these first two methods doesn't really make sense. Some definitions here. A revenue object is anything for which you require a separate measure of revenue. And then a bundled product is exactly as it sounds, a bundle of 2 or more products or services that are sold for a single price, but where the individual components themselves could also be sold separately. Again, you could walk into a McDonald's and buy a fries, right? You could buy a burger on its own, but both together are typically sold for less than if they were each individually acquired. I hopped onto the Adobe website just to take a look at some other examples of a bundle. They make a number of different products. If you've never heard of Adobe, they've got Photoshop, Illustrator, InDesign, Muse, and so on. Now, if you want, you can rent any one of those applications for $14.99 per month US, or if you pay $34.99 a month, Adobe will give you all of the products together. Now, even looking at this first 4 products in the bundle there, you probably recognize Photoshop and maybe even Illustrator or InDesign. I highly doubt most of you would recognize Adobe Muse. Now, the reason I bring that up is even though they each individually sell for $14.99, I think you'd agree that if you were paying $34.99 for the bundle, you're probably not doing that for the sole purpose of getting Adobe Muse. You're probably paying for Photoshop or Lightroom or Illustrator or some of the more popular products that Adobe puts out. Now, the reason that's important is if you're the product manager, let's say for Adobe Creative Cloud or for Adobe Muse, you would want the appropriate amount of revenue allocated to you, but at the same time, if you're the developer or the product manager on Photoshop, you would probably demand a lot more because individually, you could probably sell Photoshop anyway. Right? So just by being in the bundle, you wouldn't want to take a hit to your revenue by someone buying the bundle and then not buying Photoshop on its own. The standalone revenue allocation method uses product-specific information. And again, I've alluded to some of those examples. You might be looking at the selling price of the product itself. You may even look at the manufacturing cost or the number of physical units that go into a particular bundle. If you buy a bag of Halloween candy, maybe there are 10 Kit Kats, 4 Snickers, and an O. Henry bar. Or whatever it is. I mean, again, you could look at the physical number of units that are in the bundle. You could even use product line revenues as an allocation base. In the incremental approach, in contrast, we are going to rank the products themselves that are in the bundle. And again, you could use a number of different criteria for this, but quite often a customer survey is used to say, okay, which one are you really paying for? Like, is there a reason that you're paying this much money for this bundle? Which product most interested you? And then based on that, you could then rank the products and say the ones that are highest ranked should get the most revenue. Some key definitions there: they call the first ranked product the primary product, the second ranked product the incremental product or the first incremental product, and so on. One last point to mention here is that this is a zero-sum game. The more revenue that's allocated to one product, the less revenue that's allocated to the other products in the bundle. And again, this is important because if you're the manager of one of those products, you probably want as much revenue allocated to you as possible. Alright, changing gears somewhat, looking at activity-based costing, where the customer themselves are the cost object, we're talking here now about shared costs. And shared costs can be classified into one of 5 categories. The first is the customer output at the unit level. This is a cost to sell each output unit to a customer. This might be product handling for an individual product. At the batch level, we move up a level, and now we're talking about the costs related to a group of products sold to a customer. So for example, maybe if you are processing the order, this might be a batch level cost. A customer sustaining cost is a cost to support individual customers, regardless of how much they order or how many batches are delivered to them. This might be like a site visit you know when you visit the customer from time to time, or maybe a display that you keep at the customer location that's usually rather independent of the number of products you actually sell. We've then got distribution channel costs, and those are costs related to a particular distribution channel. An example of that might be brick and mortar versus online. A brick and mortar, like an in-store, might have a manager who manages that particular retail division, and their salary would be associated with that particular distribution channel. Corporate sustaining costs are costs that cannot be traced to individual customers or distribution channels. Okay, so why does all of this matter? It's because of something called customer profitability analysis, and here we're trying to see how profitable an individual customer is. In your book, they feature 4 different customers, customers A, B, G, and J, and to date, I still don't know why they haven't gone with just A, B, C, and D. So here you've got 4 customers, A, B, G, and J, and a couple of things just to point out here. If you were customer A, clearly you're spending more than $500,000 at this particular store, so you feel like you're a big customer. But even if you're customer G, you're still spending $41,760. So you don't know that you're costing this business money, and you also don't know that you're a really, really small fish in a giant pond of revenue. Right? $41,000 compared to $600,000 is not that much. So customer A is buying 42,000 cases of whatever it is this customer sells. Customer G is only buying 2,900 cases, or 7% of what A buys. Okay, now the reason that this is important is because if we now look, despite only having 7% of customer A's number of cases purchased, customer G has half the number of purchase orders, 2/3 the number of visits, 1/3 the number of deliveries, and again, you would expect those to be much, much smaller. And in fact, they've even got twice as many rush deliveries. Well, 2 versus 1, but still, twice as many. Now, to improve profitability of customer G, because as you can see down at the bottom there, customer G ends up actually costing our company money. So on the 41K in revenue, because of all of the different costs we incur to service that customer, we actually lose money on them. Now, a couple of things that are really important here is that in cost accounting, especially for those of you planning on going on in accounting, the calculations are important, right? You're going to need to be able to work out the number of costs, or the costs for each of these customers. But equally important, and in fact on the CFE, which is the exam you'll write as a CPA, the analysis you bring to the table, then the qualitative analysis you bring to the table, is really what distinguishes you from your peers, right? Are you able to now think this through and think about, well, what could we do to make this situation better? In this case, customer G is costing us a lot of money because they have a large number of rush deliveries, and in fact, too many purchase orders for the amount that they're ordering. So think of a larger company that maybe you know and love. Let's talk about Amazon. What do they do to get you to order more things at the same time so they can minimize the costs in shipping? Well, they might give you a discount for ordering more units at the same time. They might tell you that you get free shipping over a certain amount. Right? So all of these different things could mitigate the amount of cost they're incurring. How do you minimize rush deliveries? Well, you probably charge for them. But again, these are the things that you'd want to tell your user if you're explaining to them what they could do to solve this problem. So you could charge for rush deliveries, maybe you charge for small deliveries, all in an effort to get customer G or other customers like them to minimize the costs that we're incurring to service them. One way we can portray how these customers are actually making us money or losing us money is in a bar chart of customer profitability. So here you can see customer B and customer A make us a lot of money, right? Operating income per customer. And in fact, customers G, H, and I actually lose us money, right? So if you look at the total operating income per customer, you can see that if we were to technically drop customers G, H, and I, it could make us more profitable. But ideally, we would want to figure out how to actually make money off of them as opposed to firing them as customers. The book then talks about price discounting, and I think most of us are familiar with getting a discount in a store. It's a reduction of selling price to increase the amount you buy. Typically, you trade the lower sales price for a higher number of sales volume. And again, customers tend to like getting a small discount or a large discount, and in fact will buy from you more often or more frequently when you offer them a discount. We should track discounts by customer and salesperson though, because one of the worries we might have is that a particular salesperson might always be giving a discount, and we really don't want that. Okay, in terms of customer cost analysis, we do break the customer cost hierarchy into different categories, where you've got the different types of drivers, cost allocation bases. It can also be quite difficult for certain types of costs to establish a cause and effect relationship between the cost itself and the benefit received. Okay, so what are some factors that we would look at in establishing customer profitability? One of them is the likelihood of customer retention. So how likely are we to keep this customer? If a customer is likely to be a customer for a long time, we may be willing to give them or extend to them a large discount early on just to establish them as a customer. TELUS, for example, will give you a free TV if you sign up for a 2-year program. Right, so there they've locked you into 2 years, but they're giving you a TV up front to sign you up. Potential for sales growth. Again, looking at how much are you spending now? Are you growing? Are you going to be continuing to grow? And again, if you are, maybe we'll give you a larger discount now just to sign you up, knowing that we're going to make money off of you later on. A lot of the startups right now that offer you services for free are looking at the long tail, right? Or sorry, the long road or the long run. Facebook, for example, you don't pay for it, but they know that they're going to sell your data. They know that they're going to use you to generate advertising revenue. There's also the long run in terms of customer profitability, right? How much money could we make downstream? And equally, we've got the increase in overall demand from having well-known customers. An example of this would be having offered maybe an Instagram influencer a really good discount on one of your products, knowing that they're then going to blog about it or talk about it on their Instagram, and in so doing might get you more sales down the road. We could also learn from certain customers. So for example, beta testers in software are very, very common. Quite often we'll give a beta tester free access or very cheap access to one of your products, but the trade-off is that they then have to provide you with some feedback about what they thought about your product, how well or how poorly it worked, and so on. Okay, and then we change gears. We now move into the profitability variances. Now keep in mind, you've learned about what a static budget is. This is keeping both the quantity and the price fixed, and comparing that to what you actually sold. In managerial accounting, you then learned about your flexible budget variance, which flexed your budget based on the number of units. Keep in mind, you looked at different reasons why the flexible budget may have varied. Reasons like your cost of materials went up or your cost of labor went up. Maybe your employees weren't as efficient as you expected them to be. Now, in this course, we are going to be looking more at the sales side. And the first variance we're going to look at is what's called the sales volume variance, under which lies both the sales mix and sales quantity variance. So if you've got a number of different products, the proportion of one product to another is considered your sales mix, right? And that can affect how much money you ultimately make. For example, if I'm Best Buy, I know that certain products I'm going to sell either at a loss or very close to cost just to get people in the store, but knowing that if they then buy other products, warranties or cables or things like that, that's where I really make my money. So on Black Friday, for example, they might try to have a few loss leaders just to get people in the door, but knowing that then they'll hopefully get customers to buy other stuff in the store that actually makes them good money. And the problem is, if everyone only buys the loss leaders, Best Buy really doesn't make a lot of money. So you really want to look at your sales mix closely to make sure that you're selling proportionately the right allocation of products. Then there's your sales quantity variance, which just looks at the raw number of products you sold in total. Right, if I expected to sell 10,000 products and I sold 15,000, well then that variance is positive. Now what could cause the number of units I sell to change could be the market size itself. Right, maybe the market itself for tablets grew and we had no basis on influencing that. If you were a manufacturer of a tablet when Apple was heavily going to marketing their iPad, well, you're going to see an increase in volumes just because of the fact that tablets are now on people's radar and that's something that people would want to buy. But we've also got what's called a market share variance, and this tells you, well, yeah, the pie might be bigger or smaller, but what size of the pie did you get? And that's your market share variance. Now, we refer to these in terms of levels. At the top level, you've got your static budget variance. And again, it's the difference between an actual result and the static budgeted amount. At level 2, you've got your flexible budget variance, which is the difference between an actual result and the flexible budgeted amount. Again, you've got the whole book. I leave it to you guys to go and read about the flexible budget if you don't remember it. At level 2, you've also got the sales volume variance. And then drilling down from there, you've got your sales quantity and sales mix variances as well. There are level 4 variances, which we'll talk about in a few minutes here. Okay, looking at your static budget variance, it's your actual result minus the static budgeted amount. And your flexible budget variance is your actual result minus the flexible budgeted amount. You do get some formulas here. I will provide these to you on the exam. The one thing I just want you to be aware of is you need to know how to use these formulas. And typically when I'm doing the questions, which we're going to do in a few minutes here, I'm going to use not necessarily the formulas, but the brackets like we looked at for chapter 13, right? The balanced scorecard variances. And the reason I like to do it that way is I think it more clearly shows what's going on. But again, you've got the formulas if you want to look at them. I'm not going to go through them in this video right now because honestly it would just be me reading them to you. We'll walk through them in the context of a few examples in just a few moments here. So this is your sales mix contribution margin variance, where you're comparing the actual versus the expected or budgeted sales mix. You've got the sales quantity contribution margin variance, and again, you can look at that. You've got the market share variance, as well as the market size variance. And again, we'll look at all of those in a few minutes. The one thing I do want you guys to know is that at each level, we can explain that particular variance through variances that are now below that level. So for example, your market share and market size variances come together to explain your sales quantity variance. Then your sales quantity variance and sales mix variances at level 3 roll into your sales volume variance, which then combined with your flexible budget variance explains your overall static budget variance. One thing I'd like you to notice here though is the market itself grew. And we know that because the sales quantity variance is favorable. And if you look at why it's favorable, it's because the market size itself got bigger. So it's not that we carved out a bigger piece for ourselves, right? If you look at the market share variance, it's unfavorable. But what we're seeing here is that the market itself grew, and as a result, we sold more product than we expected to sell. Regrettably, it wasn't in the right sales mix, right? So if we look at the sales mix variance, that's a huge unfavorable variance, which then gives us an overall unfavorable sales volume variance. We also weren't very good at managing our costs. If we look at our flexible budget variance, we notice again that that's an unfavorable variance for us. Finally, we'll talk about dropping a customer or keeping a customer. And again, we'll look more at this in the chapter on relevant costing, which is chapter 11. But if we look here, we've got a customer called Whisk. Now, if we keep their account versus if we drop their account, what we have to look at are the incremental differences of things that will either change or not change. Dropping the Whisk account will save us some cost of goods sold and some material handling labor as well. But equipment depreciation, rent, general and admin costs aren't going to change. and as a result, they should be irrelevant to the overall decision. If the warehouse space occupied by products for Whisk were going to sit idle, right, like we had no other use for those, for that amount of space, then the warehouse costs themselves also would be irrelevant. By dropping Whisk, what I want you to actually see is we would be worse off.